I just have a feeling that there will be a problem with the banks that ignites the systemic problem. And look, more than anything, the central banks, Dunnigan, they may have the most money, but as I've said over and over and over again, they know the playbook. And that's more important than anything. If you understand where we're ultimately going, then only in retrospect will those moves have been obvious. But to me, it is obvious because they know where it's going. And everything that they've done back at it, that they knew the playbook, whether it be Basel III or the reclassification of gold, or all of these decisions, even the new settlement currency and how gold must be held within the borders of the countries that possess it. So do you think there's any coincidence that all these banks not only are massively buying gold, but also repatriating it, just like India, who bought 1.5 times the amount of gold in the first 4 months of this year than they did all of last year, which was a record year? It's because they know the playbook, and the BIS is center in telling everyone the secrets or giving them the playbook and saying, now make your maneuvers and do it quietly and do it as swiftly as possible because there's going to be a change, whether it be reclassifying gold as tier 1 or issuing a new settlement currency in the BRICS nations.
In today's news recap, Goldman Sachs sees gold's price at $3,000 by year's end. Analysts at Goldman Sachs see the current dip in gold's price as temporary and expect the price to be at or above $3,000 per ounce by year's end. Goldman Sachs sees continued tailwinds for gold amid an ongoing flight to safety due to geopolitical risks, continued buying of the commodity by central banks, and rising demand among Asian households. Gold demand in China is particularly strong, notes Goldman Sachs, with the People's Bank of China, PBOC, increasing its gold reserves for 17 consecutive months. In March alone, the PBOC added 160,000 ounces of gold to its reserves of the precious metal. The gold accumulation reflects a broader trend among central banks to diversify their reserves and lessen their reliance on the US dollar, the world's reserve currency. Gold's price has risen in recent days after the U.S. Federal Reserve hinted that interest rate cuts could be on the horizon and ruled out any further rate increases. Lower interest rates increase gold's appeal as they reduce yields on fixed income assets such as bonds. Now, we'll show you the best clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
The UBS says gold has risen by 29% this year, consistently breaking records on the way up. Meanwhile, the metal has risen above our long-held year-end target of $2,600, ahead of schedule. And according to the World Gold Council, as I mentioned to you, it has historically rallied as much as 10% in the first 6 months after a Fed cut. We now expect gold to reach $2,750 per ounce by the end of 2024 and to $2,900 per ounce by the third quarter of 25. And so that's pretty significant, but not as significant as Goldman Sachs, who is talking about right now in the fourth quarter of 2025. By the end of the third quarter in 2025, $3,000 gold. By the end of the year in 2025, $3,080 an ounce. And this is elevated from $2,700 to $2,900 an ounce. Again, these banks are coming out and saying, yeah, we're moving to $3,000 an ounce. And Goldman Sachs has said that they're being inundated with precious metals requests on their trading desks, which is a very, very, very big deal, obviously. And it is being evidenced by the first time in 2.5 years, we see an uptick in ETF holdings. And so as ETF holdings pick up, as the Fed pivots and lowers rates, probably another 50 basis points here in November, this is just rocket fuel for gold, which has done what it's done, again, rallying 29% and 47% since 2022 when we saw this divergence in 2022 where the ETF started to outflow in the U.S. and gold started to go up, really. And so this 47% gain since 2022, as the public has not been involved in it, with positive real yield, and a strong dollar. Now you see dollar kind of hanging right at that 100 mark on the Dixie and could very well fall from there and drop a little bit or maybe a lot, of course. And then you see that the yields coming down and now the ETFs ticking up. This is all huge. And to see Goldman and UBS say these things is again very, very significant. They're acquiescing to the reality that, again, you can only manipulate a market over an extended period of time, done again by pushing it in the direction that it is going. And that is the key, that maybe these banks realize it's as dumb as a mud wall, like Bank of America, to be naked short in a market where the rest of the world is voraciously accumulating metal, to the point where just in the month of August, 8.1% of all the silver held that's available for delivery, and the LBMA was delivered 8.1%, over 25 million ounces in the month of August. So it's accelerating the acquisition of gold. And it's also being done in a manner to not upset the apple cart, as we talked about last week, with 160 metric tons purchased by Saudi Arabia, but not disclosing it the way they're supposed to the IMF, because they don't want to upset the big kahuna, the United States. And yet they're playing both sides of this game. Ultimately, if you just put all of these things together and realize that the commercial banks and the central banks, who are the most collectively well-informed and well-financed traders in the world, are telling you where this is going. And if you don't pay attention to the Goldman Sachs report or the UBS report, where the hell do you find it, right? Where are you going to find it on the mainstream? Are you listening to the mainstream, who isn't saying a word about any of this? It's not easy to find and read through these analyst reports for UBS and Goldman Sachs. It sucks reading it, to be honest with you. And they're 25 pages of a bunch of mumbo jumbo. And then they say, yeah, gold's going to 3,000 by the end of the year. But if you only relied upon, and that you consider yourself very well read by reading the Wall Street Journal, watching Fox News, and paying close attention to the markets, you are missing this completely and totally. There is your massive contrarian indicator. Not only are the biggest boys in the world telling you, yeah, this is where it's going, but you can't find it unless you dig. I don't know. To me, it's a massive contrarian indicator, and I would say that's probably selling it short from where it ultimately goes.
In today's news recap, silver price rises to near 31.50 due to rising geopolitical tensions. Silver price extends its gains for the second consecutive day, trading around 31.50 per troy ounce during the European hours on Wednesday. The upside of the silver prices is attributed to the safe haven flows amid escalating geopolitical tensions in the Middle East. Iran launched over 200 ballistic missiles at Israel on Tuesday, shortly after the U.S. had warned that a strike was imminent. The Israel Defense Forces reported that several of the missiles were intercepted, according to Bloomberg. On Tuesday, the weaker than expected numbers made room for the U.S. Federal Reserve to continue lowering rates. The index came at 47.2 for September, matching the reading with August's print, but came in below the market expectation of 47.5. However, Fed Chair Jerome Powell said on Monday the central bank is not in a hurry and will lower its benchmark rate gradually over time. The CME FedWatch tool indicates that markets are assigning a 62.7% probability to a 25 basis point rate cut by the Federal Reserve in November, while the likelihood of a 50 basis point cut is 37.3%, down from 57.4% a week ago. Prolonged higher interest rates keep the opportunity cost higher of holding non-yielding assets like silver, making it less appealing to investors who seek more attractive yield-bearing alternatives. Silver demand has been bolstered by China's fiscal and monetary stimulus, particularly benefiting industrial applications in one of the world's largest manufacturing hubs. However, weaker than expected demand growth in China, compounded by data indicating a decline in manufacturing activity, might have limited the upside potential of the gray metal. Now we'll show you the best clips of the latest interview, but first smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
This is my own opinion, so take it for what it's worth. First of all, what we saw during COVID was a supply side shock. And that was due to the lack of capacity, or pardon me, a demand side shock. This is a supply side shock. A demand side shock where people were loaded with funds because they were given stimulus checks and they were sitting at home and they couldn't go out and they were buying stuff online, massive amounts of stuff, right? And there was more money chasing goods that were not able to get in because of the log jams at the ports. So this is a supply side shock where it's now an issue of the ports shutting down and goods not being able to get in, but you don't have massive demand, right? It's just the flow, the supply chain flow is being stopped. During COVID, everyone was buying stuff from their computers at home, and all of that stuff couldn't get in. But what I'm getting at is that the supply side shock is far more damaging to the economy than the demand side shock, because the demand side shock, there was purchasing going on, and the economy was at least experiencing demand and purchasing and transactions. Whereas here, it's different. Here, it's a situation of products just not being able to get into the ports, and that's a bad deal. And of course, you talk about the ramifications of things like medicine and food, perishables. The majority of all the bananas in the United States, 80% or so, I think, if I'm not mistaken, come from being imported. And you know what a banana looks like if it sits in hot weather for an hour, it looks bad. So you have really big problems in terms of perishables, meats and fruits and vegetables and medicines. It's a major deal. It really is. And it's not going to get better anytime soon. If you look at China as an example and look at their ports, you have 10 people sitting in a room with computers and joysticks, and almost all of their port infrastructure is automated. You take a look at the United States, it's far from it. And this is what one of the problems is that the ports want to be more competitive, i.e. capitalism, and they want to cut their costs and increase their efficiency, which would mean less workers, which would mean more automation. They don't want that. And then, of course, you take a look at, you know, the pay that they're getting paid. They make much more money on the West Coast than they do on the East Coast in terms of the dock workers. And so, you know, the conventional wisdom is, well, why not just go to the West Coast? Well, not so easy. What are you going to do? Sail around South America? There isn't a Panama Canal in Mexico. And so this becomes a problem. And of course, a lot of the businesses saw this coming. This is something that has been brewing as their contract expired today. And so people have front run this. People have bought more stuff into the end of the third quarter here. And at the same time, a lot of them have gone the other route around to Los Angeles. But you take a look at like auto manufacturing. The majority of all the cars that come into this country are Baltimore and South Carolina. You know, what do you do? And so this is a deal that I don't think people will really feel its pain unless it starts to go more than a couple of weeks. And then it could get serious. It could get really serious. There was something that I read that said if it goes one day, it takes 5 days to rectify it. If it goes 1 week, it could take as much as 5 weeks to rectify it in terms of getting the supply chain up to speed. But who knows how long this goes. This is not something that will go away easily, because the people that own these ports, they want automation. The workers don't. They want higher pay. They don't want to pay it. I don't know how long it goes, but I don't think that you're going to see the government intervene the way some people think they will with the Taft-Hartley Act, which could come in and say you have to go back to work during the negotiations, because the numbers aren't going to reflect into the CPI. They're not going to reflect negatively by the next CPI print, which is right before the election. And with the unions, they vote in mass. And if you piss off the unions, you're going to have a large group of people turn against you. It's interesting. The Teamsters, who have voted Democrat forever, have remained non-committal. They are not endorsing either candidate. You piss off the longshoremen and their union, you're going to have a massive vote against the Democratic Party. So I think they're going to stay out of this, and it could go longer than people are really bargaining for. So, if you need to get your car fixed and need parts, you might want to ramp that up and bring it in right now, because the majority of all of these parts and actual automobiles themselves come from the East Coast. But again, the big problem here is that it was better for the economy, even in the middle of COVID, when we had the demand side shock, where there was more demand than there was capacity to bring it in, than there is here, where it's a supply side where you don't have the massive demand, but you can't get any of the goods in, and that's going to create a bigger problem for the economy ultimately. So it's a bad deal. It truly is, and it'll be interesting to see how it plays out, certainly into the election.
What do you think of today's show? Do you agree with Andy? Are you bullish gold and silver like Goldman Sachs? Post in the comments section down below your honest opinion and share with the stackers your views on the metals. Thanks for watching. Now peep this video right here because it's a perfect fit for you. I'll see you on the other side.